I will agree with you that high yield spreads are at their all-time high, tights, but that's for a good reason. With the advent of private credit, high yield has actually moved up in quality. They decided to take their ball and go home. So you are actually seeing historic tightening because about 60% of the index is now double B, one notch below investment grade. But where we are seeing opportunities, and the really great opportunities in credit opportunities really come when there's a high volatility and forced selling. We do have some higher volatility, but the real forced selling isn't there yet. And I will touch upon really quickly where we're seeing opportunities today. But what's really unique about sort of what this time in the industry and for the first time in my career is that there is a pipeline of defaults. Whether we have an intense economic cycle, whether we have a recession or not, we are going to have a default cycle because there is a pipeline of defaults that are already baked into the system from the what I will call LBO bubble from 2021, and that was $2 trillion of transactions in 2021 and 2022 in some of the most highly levered balance sheets. And there's about $165 billion of LME paper. That is some of the worst paper in the industry with 66 issuers. And even the super senior paper is now trading at distress levels, average price in the 70s. And that's $90 billion, and there's another $75 billion that's subordinated to that. So those are defaults that are ready to go. And when you have that level of default, you are going to have some forced selling in the markets. But in addition to that, there is a maturity wall that's never really come into fruition. It was actually one of the biggest boogeymen in the industry. Maturity wall is going to get solved. In this instance, because the refinancing market was so wide open in 2024 and 2025, we have an additional $500 billion of maturities in the next 2 years that need to be met, and a lot of those companies didn't refi because they couldn't access the market. So we're talking about a big sort of backlog of default away from any economic or dislocation from consumers changing their behavior from the oil shock or any other inflation-related economic inputs.